Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest inflation numbers with an expectation across the forecasting board, if you will, that inflation will have pulled back from that peak. 7.3% it was in June. We thought the annual rate could come back. Our forecast was for 6.8. The market was sort of picking a little bit lower than that. The Reserve Bank, I think, were picking 6.4. We were all surprised, alarmed, in fact, when it came in at 7.2 on an annual basis. That was a 2.2% quarterly increase, the fourth largest since 1987, and really underscored that despite fuel prices coming back, we knew that they had declined 4.5% odd in the quarter. Everything else had gone up at such a stonking stronger rate than expected that you saw virtually no real movement in the peak of inflation. When we look through those details, we know that food was a major contributor, 35% of that quarterly increase coming from food, particularly fresh fruit and vegetables. Building as well, particularly construction costs, but also rates rising at their fastest pace since 1990. Just a lot of pressure in the system. I mean, when we look through those sort of details, is there any relief in sight yet when it comes to inflation?
No, there's not, and that's probably the most disappointing thing about the numbers is that yes, we knew we thought that the headline number would peak, but we're also expecting that maybe some of those core underlying pressures would just start to show maybe signs of easing, but that's really not the case in the numbers, and it does seem to be stronger than ever, and so that does have major implications, I think, for where the Reserve Bank goes to from here, and we have seen forecasters across the board revising upwards their expectations of both the upcoming move by the Reserve Bank in the official cash rate, but also where the peak in the cycle might be from here. So yeah, there's a lot of pressure in that system, and I think what makes it even more disappointing is the fact that we're 12 months into the tightening cycle now. This is the sort of around about the time you'd expect to see the impact of decisions coming through from a year ago, starting to impact on some of the outcomes that we're seeing. And let's be honest, we certainly haven't seen anything with inflation. We haven't really seen a lot in terms of real economic outcomes either, apart from a housing market that is obviously falling quite rapidly in terms of house prices. A lot of pressure there, but then it was well overblown in terms of the strength of the market previously. And also we've seen a bit of softness in household spending, but probably the worrying thing for me is that although you're getting household demand weakening, that is not translating through to a point yet where businesses are going, no, we don't want to put up our prices. We don't want to pass these cost increases on because we're worried about our revenue stream and losing market share, all that type of thing. At the moment, the evidence is still very much, I think, that the economy is still highly stretched, even with the easing in some aspects of demand that we've seen. And so that does feed through into the need for more action by the Reserve Bank to get inflation under control. We're worried they might not see much evidence before early next year. Well, even that's feeling a little bit optimistic now in terms of how long the official cash rate keeps rising from here on.
Absolutely, and when you look through those numbers, I mean, realistically, there's the potential for inflation actually to still head higher if you have another sort of decent amount of inflation in the next quarter. Effectively, that 2.2% quarterly rate really does raise the chances that actually we haven't really done enough yet, and you're barely seeing a stabilisation in the inflation rate. I think also when we look through those numbers, that they were alarming by how hot they were, but like you say, inflation is now ingrained. It is persistent. It's stubbornly sticking around, and it's very much broad-based. It's quite pervasive, in fact. I think the worry there is that you're not seeing it really on any metric, that slowdown that you have discussed, in terms of what the Reserve Bank was wanting to see. With that, everyone, I think, was hoping and again expecting inflation to pull back, and that to allow the Reserve Bank over time to stop needing to raise interest rates quite so quickly. The desperate sort of levels of inflation that we are seeing at the moment immediately prompted us, everyone else, to also raise those views. The Reserve Bank, the last time they put out their monetary policy review, highlighted in the notes that they had mused about 50 or 75 basis points. And with that on the cards, we and everyone else have moved to that view that a 75 basis point increase needs to happen in the November review, just because of how hot inflation is, and the feeling that effectively we're still not nearly on top of inflation at all. We're still playing catch up. If you go 75 at this point, though, you're going to have to go further into the new year. Like you say, we're not going to have evidence that inflation is under control very quickly at all. So you sort of go, 75 basis points takes you to 4.25% official cash rate. You move through into next year, and you're probably looking realistically at an OCR starting with 5 at some point. Maybe further than 5.0, maybe not, but realistically, that's a huge amount of pressure. Realistically, when we look through those numbers, though, when you have such a high official cash rate, you are going to see a lot more mortgage pain than we have seen before. You know, people who were all right under the old assumptions, if you will, they're now not going to be as we move ahead. And realistically, because inflation is now sticking around greater for longer, more persistently, you sort of, as the Reserve Bank, you sort of almost need to tip the economy into that feeling of a hard landing to get things under control. I mean, given where inflation is at the moment, given, like you say, what the indicators for spending are, Gareth, what is the likelihood that the Reserve Bank can ease up anytime soon? What are we looking at both internationally but also domestically before the Reserve Bank can pull things back?
Yeah, I guess there's three things that concern me about the inflation outlook going forward. There's a lot there, but three main things. And one is the exchange rate is, particularly against the US dollar, obviously come down a long way, and we won't yet have seen the flow-on effects of that in terms of the price of goods coming over the border. So that's going to feed through into more pressure going forward than we have seen so far. You've got transport costs. Yes, international shipping costs are coming back, not so much for New Zealand routes, but there's still a bit high, but probably more importantly, domestically, we've seen diesel prices stabilising at somewhere around about $2.50 a litre, which is better than where they were a few months ago, but it's still well up on previous levels. And so I think there is still more to flow through there as well. And then probably the most sort of pervasive or long-lasting one in terms of the concerns for me is just the labour market. And at the moment, we're still at an unemployment rate which is 3.3%. That will start to rise, I think, over the next few quarters as the effects of tighter policy come through. But the reality is that those people who are working, they are going to be looking for some significant wage increases to make up for the higher cost of living that we've got. And until we get some improvement in the labour supply, more people coming over the border in terms of immigration, maybe that type of thing, that is going to still have to be pretty much a must-pay situation for businesses to try and keep them on board. And that's going to keep flowing through into higher costs as well. So you're looking at those indicators, probably fuel prices and the labour market in particular, and going, when are we going to see some relief on those? Fuel prices are a little easier perhaps than the labour market, which will tend to lag in terms of some of those wage increases. But yeah, the Reserve Bank, I think it is going to be well into 2023 before there's any clear indication that they have started to get on top of those inflation issues.
Agreed, and I think the worry right at the moment is that the expectation is that you lift interest rates over time. That means that people pay more for their mortgages, have less money for other things in the economy, stop spending quite as much in the shops. Businesses go, well, actually, I can't maintain pricing pressures at the moment because I don't have as much business. I need to, restrain myself a bit because otherwise it's not going to happen. The risk, I think, at the moment is that you've got a lot of businesses who, even irrespective of where their sales are going, man, I've got a lot of cost pressures that are piling on. If I don't pass these on, I don't actually have any margin left to work with. And so I think what you do very much see here is, because of how much inflation is persisting, the Reserve Bank now has to push harder, which again, realistically has to, odds on now for a hard landing, because that's actually what the Reserve Bank wants to see, is pricing come back rather than economic activity. They will not be content with economic activity itself coming back. They need to see those signs of inflation. So I still think we've got a fair way to go. The interest rate increases have not ended yet, but the repercussions for the New Zealand economy are only just beginning. We'll assess how inflation continues to develop, what the interest rate response from the Reserve Bank is, and how the economy develops as we go forward on one of our future editions of Econ Talks.